Hello, everyone. Let's get started with our usual Friday get together. A lot going on as usual in the markets in Jackson Hole today. So it's been probably a decent month for the trends, a lot better for me than last month. Don't forget to send me some questions, direct message on Twitter if you don't want to speak. And I saw some good tweets this morning that I was sort of wondering what I wanted to bring up today. Of course, I'm happy to talk about anything you guys want to bring up. Um, but I saw a couple of good tweets. One from Rich this morning. Be good, nice to hear what his comments. And then my favorite topic these days is managed futures replication. Niels just winced. Sorry, Niels. Yeah, I mean, I really think this is something very, very interesting. I'd love to talk about this. We discussed it a few weeks ago on some my friends and I on some emails, and I didn't have a lot of opinions, or I hadn't thought through this replication, managed futures replication, DBI, ETF. Um, but I have. I've been thinking about it, taking a lot of notes, and I think it's something that should not be dismissed. It is growing. His fund is doing really well, and he's great at what he does, and the performance is great. Arthur posted a tweet today talking about the performance. I think it's outperformed SocGen CTA index since it started. Like he said, probably just by the lower fees that the ETF charges. So that's a fun topic. I mean, fun slash not fun, but not something to be dismissed and thinking it's going to go away. And then other people were posting some funny stuff about it. So that's one thing we can talk about if you want to. Okay, so let's get going and let's talk about a lot of different things, anything basically, if you want to. So I have invited Rich and Oleg to speak, whose technology is going to work the quickest.
Hi there, can you hear me?
Yes.
Hey Jerry, hey Richard, hey Oleg, hey everyone else. So this week I was actually when I was listening the Neil's podcast, I was just noticed words which is iconoclastic, and I thought a lot about that. So individuals who are iconoclastic has been mentioned in Nielsen's podcast when he was talking with Mark Repzensky, and mainly they use the term who actually favor the pure following strategy as opposed to a more blended version in some shape or form. And I thought, that had resonated with me. When I was having a lot of time working in London onto my day job, I was iconoclastic in the sense that I didn't see a lot of sense just working on a day job and trying to get retired at the age of 65. So I was iconoclastic back in the day, and now at the trend following space, that term has caught up with me again, and I'll, and people usually complain about trend following because we are a little bit volatile when trading the markets. But when I look into it, I see that Bitcoin had 80% drawdowns in the last 10 years, and no one else is complaining about Bitcoin. Everyone else is happy to trade the Bitcoin in some shape or form. But when it comes to trend following, we are too volatile. So I do have I think I like to challenge the accepted belief around that, and why trend followers are not getting, the prime time that they need to get, or the share of the cake in terms of assets under management. The ARK Capital is having 1.5 billion fund inflows in the first half of 2022. But when you look into the major trend following firms, hedge funds, that is not happening even at this, in this very profitable time. So, yeah, I mean, for me, this week is all about being iconoclastic and looking into the Bitcoin and, seeing what is happening there. So that's what I wanted to share first. Thank you.
Hi to everyone. Of course, I'm telling you that I'm very happy to be here. Of course, I'm telling you that I was waiting all week. This event is very special event for me. Every trend following trading club meeting, a very special event and of course, a very special event when I every day listen top traders unplugged. It's always special, and it's almost every day. So. And of course, I'm telling you that I'm on the beautiful seaside on the Black Sea coast, in the beautiful places, like nature very much, and like trend following trading nature. And I think that trend following and nature have in common that, as I always say, there are general rules of nature, and trend following trader acts according to these general laws of nature.
Yeah, I agree with what Mentor was saying. Not only, well, you can't really put anything in the same class with Bitcoin and the religious fervor believers that, it's kind of like me. Tell me something negative about trend following, and oh well, ho hum. I'm not going to be objective necessarily. So, but certainly, not only do you get this volatility in Bitcoin, but also the S&P minus 50% drawdown and more if 90% if you look at other indices like I think NASDAQ. But what's even worse is the actual return of, around 7 or 8% historically for the S&P buy and hold. It would be difficult for a CTA to have such a poor return versus drawdown because we just trade too many markets. We go short, we cut losses, we take small losses, we let profits run. And so it's just very difficult to set up your leverage in your risk budget to achieve an 8% return and have a 50% plus drawdown. I suppose it can happen. You can just do other things wrong. But yeah, it's not going to change anytime soon. And just as things rotate, and if the S&P goes into a performing worse than the typical CTA trend follower, then maybe CTAs will gain some AUM, and I certainly predict that to happen and have many times. So, but yeah, and I too really like that word iconoclastic. I don't remember if I looked it up, but it is exactly the way Mark kind of said it, that, obviously you can do different things, be yourself, have more fun if you have less to lose. And, with small clients, with small loyal clients or no clients, you can be very outspoken and aggressive on what you believe and how you're going to do things, and tell everyone you're not going to listen to clients. But, if you're managing billions and billions and you're growing your firm and it's meeting the needs of institutions and people, investors, then, you want to make them happy. So you have to find that sort of good space where you can have a bit of both.
And I want to say that what I really love in trend following, that trend following philosophy teaches us that no market is a unique for us. Maybe, of course, it's unique, but it's not unique for us. We apply the universal rules for all the markets. And especially when Bitcoin was raising up, 1 year ago, I have listened a lot from different people. I saw a lot of advertisement that Bitcoin is unique. It's ridiculous, marvelous. It's incredible. And if you put there 100 United States dollar, it will be $10,000 in a year, or maybe even more than that. But one guy asked me 1 year ago, what do you think about Bitcoin? And he told me about his thought that it's unique. And I said that I don't see uniqueness in this. And what are telling me is against the laws of investments. So if you are talking to me that this undiversified, concentrated bet is a very good idea, there is no reason to think that it's a truth. So I don't recommend you to invest only in Bitcoin. Have a diversified portfolio. So here is my point.
I just wanted to say that what trend following is different, and that's a fact. That the equity curve that you get is different. And I was thinking about when you said about managing other people's money, etc. What's the function of trend following for somebody who is buying this product? If it's an absolute return strategy, or as some people see it, it's a complement of another portfolio. Because there's this division about people who thinks that it's a whole strategy, and people that thinks that it's a strategy that it's good, for example, for risk alpha. I think that it's an overall good strategy, but I also think that it's so different from the benchmarks that you have to have a lot of character to have it in your portfolio and to have it as your portfolio. And that's something that it's very, very important, because many people will think that it's a complement. And I think that many of the institutional trend followers set it as a complement. And I understand what they do, because it's very hard to, for example, say that you are 10% down in a year when everybody else is 30% up. And I think that it's a different on relative performance rather than absolute performance, and that makes it a very different strategy from any of the others.
Yes, Transform have the benefits that we all know. This very big benefit that Mark Zybrzynski told that, and Joseph Fielders remember that when all goes down, trend following funds go up in crisis environment. And as Niels always said, they say that trend following works in crisis environment and both in non-crisis environment. And so I see here a uniqueness of this strategy, and I like very much, as I remember, Joseph Felders. I don't remember exactly, but as I remember, he said that when the crisis occurs, the average person, he loses everything. He loses his job. He loses his ability to pay his bills, to pay his debts, credits, and his stocks went down. But in a trend following fund, it's a very different situation. So it's independent. For me personally, I think that trend following is independent asset class, and very, very, very good asset class.
Yeah, I think you're right, but the relative performance is something very, I guess, is something very important, especially if you're managing other people's money. Because, for example, in the last decade, trend following underperformed simple buy and hold, because buy and hold was always saved by government intervention. And I think that that doesn't matter, because I think the strategy is sound. But when you you get with your client or with the investment committee of an institution, etc., and you see that for example, the S&P it's 14% up in the last 10 years with just a 20% maximum drawdown. That's something very uncomfortable for the people who are making those decisions. Maybe not for somebody who really believes and is managing his money, but in the case, sorry, but in the case of somebody institutional, it's very hard to justify why you are so far away from the benchmark, especially on the period that ended in 2018, etc.
I understand what you're talking about, of course, but I want to say that I have here another mindset. I mean that I think that if you are a classical trend follower, you will have a long period of profitable, as we have seen, for example, the last recent 2 years in commodities, for example. And in that period, you become very interesting for investors, and maybe I'm not talking now about institutional investors because I know very little about this field, and I have never been in touch with institutional investors, to be honest. But I think that here we can show the performance, and we can tell how it works, and it's very interesting, and it's simple. And as Niels said, that if we look at the chart, for example, for 50-year chart, we will not find any 50 years chart without trends. So we can show this. We can tell core principles of trend following, why it's adaptive, why it's not risky. It looks risky, but you can explain why it's not, and I think it all may work. And on the opposite, if you do something to please investors, and to do investors like you to change to please them, they like something that in fact something that warehouse risks, and people by their nature, human biases, maybe they like it, but when that strategy, for example, we see an example that traders listen to his investors, do something that investors like, not the math investors, and sooner or later he will lose his money. He will lose his money, and that investors will not say, "Oh, such a good guy, he has lost our money because he was listening to us. Let's give us more money. Let's give him more money." No, they will say that this guy is not a good trader, and maybe they will say the same about the trend-following trader when he is underperform. But when he will be outperforming for 2 or 3 years, especially if he is well-diversified traders, so well-diversified trader, I think they will invest in him, and no matter what they said before.
Yeah, I don't know. I think that the relative performance to benchmarks and other investors is pretty important in the mind of anybody, and that's why I think trend following works, because even though you have that bias, you decide to implement a system that will free yourself from that kind of problems. But for example, index investing grew in the 2000s and also in 2010, and in the 2000s the S&P went almost zero for the decade with 250% drawdowns, and still people invested money there, and nobody, I won't say nobody complained, but they could weather that storm without much issue. And I think that any alternative investment model than that would not survive a situation like what the S&P had in the 2000s, and and that I think that's a huge difference. I mean, in the end, it's better for me because I think that the issue that it's hard makes it less crowded, and it will be better in the long run. But just saying that it's very different from the for the benchmark strategies.
And I don't know about this overcrowded problem. Do we need to be less crowded or not? Really, I don't know. I'm not an expert here. As Nils said, that trend following worked before. People traded in the trend following way, and trend following works now. And yes, I think that I'm sure that I'm talking about me now, that it will be working all the time until maybe all the markets will be controlled. As you remember, Nils maybe said this point. I don't remember exactly. I think yes, Nils said that. Yes, but it's the nature of markets. So, and when we are talking and here, math is a universal language. And math is our friend also, not only trend. Math is our very good friend here, and not only here. And so when we see this, people like, yes, they consider themselves as a very serious guys when they are talking about stocks. And maybe they consider themselves very maybe genius guys and innovative when they're talking about bitcoins, my thought. So when they're talking about, but math shows us that it's not the case, maybe, because if we are talking about stocks market, about S&P 500, we all know here that it's 5% maximum drawdown, 50% maximum drawdown and 8% return. And in these terms, it's very risky because we don't know. We have seen 50% drawdown. Yes, we have seen this. But we don't know what the future here can bring us. And it can bring very, very unpleasant things theoretically. And so it's not something that I would trust when you don't do any manipulation like we do in our trend following trading. If we see that we must close our position, we close it. If we see that we have a signal to open, we open this, and we do it in a very robust way. And here, when we only buy and hold and nothing else, I don't think it's. I don't think that it even looks safe if we think more deeper here.
Hey, hi everyone. Glad to be here. On this topic, I think, well, sometimes we recognize it's a good strategy for our particular tastes. I would say it's the best one, but we also must recognize that it's not the best for everyone. Perhaps people have different approaches to life or different problems to solve. In that trend following, it's not exactly what they want. They're okay with a negative skew of stock indices or buy and hold. They're okay with for a lack of better word, for the usual investment strategies. And perhaps it's better for us to find a way to show people how trend following can complement their portfolios. In that sense, I think last week's article from Cliff Asness do it perfectly. Yeah, it's true that, or at least for most of us, I would say that trend following is not designed to have negative or zero correlation with stocks or with the usual investments, but it is a feature. In a sense, it is a fact that usually when stocks go down, trend following goes up, or at least it doesn't go down. And So why not sell that to people, or better to say, why not show people that this is a feature of our models? Yeah, for our from our point of view, it's not even close to the main thing, but for everyone else, it can be. Why not? And I'd like to chime in that a topic that Jerry brought up as we started talking of the managed futures replication. I couldn't read deep into it, but I'm not sure if I understand this correctly. What are they doing actually? Are they trying to replicate the positions of the SocGen trend index, from, I don't know, from running regressions and trying to identify what's going on inside SocGen, or did they actually develop a system that performs or that behaves similarly to SocGen? Do you have any light on that? Thanks, guys.
Yeah, I think that what they're doing is replicating the positions. So obviously there's a bit of a delay, and they're, of course, they want to have the same performance as the SocGen CTA index. I think there's a couple of different indexes out there with SocGen's name on it. The one I'm familiar with doesn't have 20 CTAs, so I'm a little confused. But anyways, they are doing a good job of keeping up with performance. They have an edge in the fact that they charge 85 basis points compared to the CTAs in that index that probably charge a management fee and an incentive fee by and large. So, yeah. And so I've seen people ask questions on Twitter like, what's the leverage? What's the AUM? What's the trade level? What are they shooting for? Well, whatever everyone else is doing in this index, it all gets boiled down in this replication to have on these type of positions, and the positions are posted daily. And I've heard people say that it's 10 positions, but when I looked at the positions the other day, there may have been 13, 15. So I'm not really sure if they're stuck on 10 or a certain number. I suppose the computer tells them what to do to replicate the recent performance. And remarkably, it does a really good job. So, they're short interest rates, futures, and short the yen and the euro. A long crude, I think long the S&P as of a week ago, and then maybe short a couple of other indices that are, I think there were 9 U.S. indices. So it's remarkable, and it's kind of funny, and I have a lot to say about it, but I'll let you comment on all of that.
Yeah, I don't know. I have some issues with that from a risk point of view. If you're trying to replicate something and you're not exactly sure when you're out, I mean, when does a trade stop? Or they're basically trusting the next trend follower on their side and not exactly on their process. I don't know. I'm not sure. I'm not sure if this if this is as reliable or as robust as classic trend following. I mean, as robust as developing your own system, knowing its limitations, knowing how deep can you go on a single trade. I don't know. Perhaps the computer tells you, yeah, everyone is going nuts with the crude. I don't know. And what are you gonna do? You're going to follow it? How long will you follow it? How can you trust it? I'm not sure.
Yeah, Bruno. G'day, everyone. The CTA replicators were spawned on the basis that, in the absence of having information specifically about what's under the hood of the trend followers, they use a process of reverse engineering where they use simple models and reverse engineer back tests to produce a similar equity curve. And once they massage the equity curve to a particular level that can mimic a program, they believe that they have replicated that program. And this was first started out by Andreas Klenow in his book Diversified Futures book, where he was looking at the different equity curves of the different CTAs, and he was going through a mimicking process where he'd be selecting a universe that he believed mimicked the universe that they were trading, would adopt models that he believed mimicked the models that they were trading, and then could generate these equity curves that, in backtest land, they certainly do come close to what these particular programs are doing. But it's in the absence of the specific information that actually occurs with the trend followers. So that's why they're referred to as CTO replicators. And the problem I have with that is that they're using a process that, my issue is always backtest. And I demonstrated this week with a backtest of using hindsight, a collection of 10 different trend following programs to produce this fantastic equity curve that I knew was a massage result because I had the benefit of hindsight. And this is exactly what the CTO replicators are doing. They're effectively deploying a backtest on what is known. So they're not they're not taking their environment in a forward test environment into unseen data. They're applying their test results or on a known history. And of course, they will always have the advantage and be able to manipulate and sculpt their equity curve in every manner they wish to do because they have that known history. And I can massage an equity curve if I have known history. I can produce a fantastic equity curve, which is called, my optimal backtest. But the reality is that when the trend followers that they're attempting to mimic have got a long-term validated track record of unseen data, and that is a huge difference to what CTA replicators seek to achieve. So I believe that, yes, they will be able to demonstrate through their back tests that they will be able to mimic the returns of the trend follower. But I think when it comes to the reality of a long-term track record going forward into the future, they're going to fail abysmally. And I know TransTrend had real issues with this about 5 years ago when I was about CTO replicators, and I totally agree with Harold there in that, you cannot reduce the importance of the validated track record, the skills of the manager in being able to take their programs into an unseen environment that is a totally different context to massaging or generating a backtest result to mimic someone based on what is known. As we all know, trend following is about an uncertain future, managing uncertainty, and the skills of the validated track record far exceed that can be generated by a backtest.
So I share the same concerns as Richard and Bruno just laid out, but I just want to add one more thing to that, and that is, I really don't understand why there's so much focus on the fee as if it's the only thing that really should decide for you which manager to go with. At the end of the day, it's about the net performance that we generate. So it's completely, as long as it's reasonable, of course, but it's completely irrelevant whether you're charging 85 basis points or whether you're charging 1 and 20 or 1.5 and 20. I mean, look at the net performance. And then on top of that, I would completely agree with both Bruno and Rich. I think there's so many issues with not knowing what's going on. And I guess, they would be out of business if SocGen stopped publishing this data every day. What kind of business model is that, frankly? And it's not that I want to be negative, because actually the product, if for some institutions that they really want this and they think that this is more what they can get through their investment committee, then actually it's doing a great job, because it's helping people who otherwise wouldn't have exposure to trend following to get exposure. And that's a good thing. So I'm not against the product. I just see all the red lights that Rich laid out, as well as Bruno.
Well, I have to say I like it. I like it a lot, and I hear what you're saying, and I definitely agree with the part about CTAs in this index and SocGen or whoever needs to defend themselves, and that's what I'm saying. my issue is that, well, not just one issue, because I have a lot, but one is like, what are you going to do about this? And don't sit back. It's not going to go away. They're raising too much money. And look, you know the answer to the complaint you raised, and that is that people are attracted irrationally to lower fees. One, all things being equal, which is what his whole business model is, I'll do what they do. Why not pay less? I don't even know about this investment, whether it's the SocGen index or whether it's the replicator, but at least I'm a little bit ahead of the game due to fees. And then it's very difficult to get uh, investors to look at, don't worry about the fees, look at the net return. Well, the problem is that's in the rearview mirror, and now we're dealing with the future. And to get an edge and add some possible advantage in the future, of course, if I can get the same thing or close to the same thing for less of a fee, then that's going to be attractive. But I do think that these guys need to protect themselves and try to do something about this. But I have a lot more to say. Go ahead, Niels.
Yeah, no, I was just going to say, I think it all comes down to one thing you said, and that is they're doing the same thing. In my world, they're not doing the same thing. As Rich laid out beautifully, they're not doing the research. They don't know when to get in and out unless they can, do some kind of regression on data from other people. So I think that's the difference. They're really not doing what we're doing. They're doing something different, and if people are happy with that at a lower fee, great. So I agree with that. But don't be fooled that they're doing the same thing as we are. They're not.
Oh, yeah, you're right. They're not doing the same thing, but unfortunately, they're having the same performance. And I think this is a logical and more reasonable implementation of AI than trying to outperform the CTAs themselves with some sort of AI product. But they're having success, and their performance is a bit better since it started than the index. So it's good. It's okay to predict that it's not going to continue, and it is definitely unfair, and it definitely will change. And I do think that you almost got to another point of mine, which is that what if it doesn't work? What if these CTAs they're replicating, they shouldn't be replicating them? And to some degree, where is the due diligence to the clients buying the ETF when you're not so sure that it's going to be great in the long run? So maybe the opposite of what you're getting at is that these are wonderful CTAs and they're doing something that this replicator is not doing, but also you've got to put into the equation the possibility that these CTAs will not perform so well. And what would the replicator of the best performing ETF be if they would have chosen to replicate Kathy Woods?
I'm going to wait till the wheels fall off, Jerry, because imagine if they tried to replicate us during 2015 through to 2019. I think they, like Harding, wouldn't be replicating us for very long, and they'd be out of the game before they knew it. It takes a different skill to be able to go through an unfavorable regime, and I don't think they've been tested long enough yet to basically be worried about the fact that they're going to outperform us.
Well, actually, I heard Andrew, and he's very good at explaining these things. And I heard him talk about on a podcast that through that period, 15 to 19, and I'm not entirely sure if they had another product before this, because he was saying, that they were outperforming the index by 400 to 500 basis points. And I thought that's weird because they're only saving fees of about 100 basis points, and certainly in a flat period where there's no performance fees, probably that saving could be even smaller. So how on earth, if the claim is correct, how on earth did he outperform by 400 or 500 basis points? And actually, and again, this is very dangerous because we shouldn't look at short-term periods for sure. But I did notice that if I go on my little iPhone and I look up the ticker and I go back 1 month, and you can look in that stocks app, you can see the performance of their product. it's actually down in the last month. And I don't know many trend followers in the last, and I don't mean the calendar month. I think this is a 30-day period month. I don't know many CTAs or many trend followers that would be down in the last month or so. So I agree with Rich that over time it'll be more clear to see where the differences really lie. And I'm not saying that it's going to be negative, um, but in terms of generating great performance, I mean Bernie Madoff generated great performance. So I completely agree with what you said, Jerry. That where's the due diligence? I mean, there are lots of issues that I have with it, but I go back to this thing about, well, if institutions really want to buy this, let them, because I would rather they have exposure to trend following and their portfolios do better from that fact for their clients, for their pensioners, than they don't have it. But if you really want exposure to trend following, don't buy a copycat, buy the real thing.
I mean, is it possible? I mean, I'm not close to this replication business at all. So, what is their basis? Are they just looking into these NFA, CFTC, and SEC submissions and see the actual positions of long-term trend followers, and they are trying to get into those positions? Is this their process? Is this what you mean by replication? And if this is what they are doing, they are replicating through looking into these documents, then is it possible to say that they can replicate a longer term strategy but less so for a medium term strategy, because within the next submission those positions the turnover are going to be a little bit more frequent compared to a long term trend trader? Thank you.
Yeah, no, that's not what they do. They don't look at actual positions. They're just trying to replicate the performance by linear regression from the index. So they have no insight to what the actual positions are.
When my first visit when I went to London many years ago, I visited a CTA, large CTA, probably the biggest and probably the most famous. Everyone knows him. And I had an opportunity to go visit him at his office. And the very first thing he said to me was, I replicate all the CTAs. I want to know what everyone is doing. And I guess it's a form of research. I've heard other famous managers say that as well, that they want to open up a managed account with a trader or do some regression to try to understand what people are doing to help them sleep at night, so they can say to themselves, well, there's nothing there that I don't already know, so I'm okay. But I do think, okay, I'll go to my next big punchline. I do think that it's funny, and I laugh because I think essentially what has happened. I'm out on a limb here, so I need Rich to bless this or shoot it down. Just this one narrow point, and I think that it's kind of funny that all of this complexity and additional features, vol and correlation management, dynamic position sizing, have created the opportunity for a replicator to replicate with such a few number of markets. They've actually made it easy, whereas you can't replicate me unless you're going to trade 200 markets, because I'm driving my performance by each one of those outliers, which are totally unpredictable before they happen. And so somehow they need to, this is their comeuppance, that if you're going to have strategies within your trend following that limits the outlier performance, to get it back in line with because of volatility and correlation, they're essentially setting themselves up. They've demonstrated it. They have demonstrated over more than 1 or 2 years that they can do this. They are doing it. Maybe they won't, but but if Andrew wants to trade 200 markets, get my list of 100 stocks, and replicate me as well. So I think it's kind of funny, and I think it's not something to be dismissed.
when you try and replicate a Toyota, you get a Lada at the end of it. And I think that's what's going to happen with these replicators.
Jerry, I think that manager is not in the index because they don't show NAVs and positions daily. And one time I went to see them also, and I wanted to open a managed account. And it's funny what you said, because they told me, sure, we can open a managed account, but just in case, if what you're trying to do is trying to reverse engineer what we do, don't waste your time, because it will be such a lot of complex information that you will get on your managed account that you won't even understand what we are doing.
I'm sorry for the interruption, but it was very, very funny for me when Richard said about Toyota and Lada, and I want to ask, how do Richard knows that Lada is totally bad car? Because as I have heard, that Ladas that goes to export, they are much better than Ladas that inside Russia. It's totally awful.
Yeah, look, it was just a joke, Oleg. No sort of an insult meant there. It's just that anyone who tries to replicate something through reverse engineering, yes, you can always reverse engineer a process, but it doesn't necessarily. It's a bit like a correlation does not imply causation. There is no guarantee that you have fully replicated that underlying strategy unless you know what's under the hood. And so the assumptions embedded in that replicated strategy through that reverse engineered process might certainly, from a historical perspective over 10, 20 years, be able to mimic that equity curve produced by that trend follower. But as you and as all of us know, that is one possible sample set from 1,000 different sample sets that a trend follower can produce. That is one outcome, and the outcome is dependent on all of these sort of contingent events through that time series that have to line up in a particular way. They've got to mimic the universe that's being traded exactly. They've got to mimic the signals exactly, if they don't do that, they still can mimic that equity curve, but it means that there's some faulty assumptions in that logic. And that's the problem you face with anyone who tries to replicate a good product. Like the Japanese replicated the British Navy, and they certainly got a great big navy from that result, but their battleships were certainly inferior to the British battleships. And it's the same as, replicating technology. You can get a proxy for that result that looks all good until you look under the hood, and then you see that it's, what in Australia we call a mudguard, which is shiny on the outside, but SHIT underneath.
By the way, you are very right here. We're right here in terms of cars, even because in Russia it was not replicated, but it was factories of Ford and Toyota. As I remember, maybe in Kaliningrad and in St. Petersburg. Yes, Toyota in St. Petersburg, the factory. And I have heard many times that it's the same details from the Japan, maybe the same equipment, but the technology process, it's not the same in 100% way. Maybe, I don't know, maybe similar to the same, but Russian engineers and Russian workers can't do. In fact, they're doing replication, and that cars are not so good. I don't know, does this factories work now or not? I don't know this. I wasn't interested in this. But a year ago it worked, and these cars was not so good as cars that have been done in Japan, and it's a fact, and I think all Russian people know that.
I do think I think this is going to spread. It's going to get bigger. It's not going to be as easy as it's been for this fund, this ETF. But I do think another way, I don't know anything about replication, of course, and how it's done and the limitations. But one thing I thought of was it would be better. I think maybe Rich and Niels are hitting on something. Unfortunately, it's this may not. If this is in the cards, it's not going to help the group of CTAs that they're trying to replicate. But it could be something where you change the replication to have the computer learn the rules. So not the positions, but the rules. And that way you can perform some due diligence on the rules, and you know what you're doing and you know what you're giving people. Ipso facto, the SocGen Trend Index, CTA Index, is wonderful and great. I don't know about that. That's what I'm saying too, which is maybe, maybe not. But knowing those rules, so you take the replication in a slightly different direction. So you don't wait to see the positions. You just, every now and then, you replicate on a month end, and you're going to use many, many years worth of data to, and I think this was what this CTA was saying, this famous CTA was saying. I'll look at their monthly performance over the past 10 or 20 years, and I'll replicate that that performance, that equity curve, like Clino, and I'll back into their rules, and I think that could be a bit better. And so, what are you going to do then? Just stop showing your performance?
Yeah, but the problem is the number one question, or better to say, the number one answer we say every time. The problem is the sample size. How can you understand what rules everybody's using on an ongoing basis? If you get Chesapeake's return profile and try to understand what rules were being used at every point in time, I think that's a daunting quest, but it's possible, perhaps. But I'm pretty sure we cannot forecast what rules are you going to use the next few days, the next few weeks, months, and years. So as time passes, I'll be trying to forecast what rules are you gonna use on Chesapeake to try to replicate your performance, but the sample size is minimal. I don't think that is even possible, even with big technology, for lack of a better word. Yeah, and one thing is to understand what everybody's doing and try to learn from that and try to incorporate in your own rules and say, okay, this makes sense, this doesn't. Okay, here is why everybody made money and I didn't. So I'm going to figure out if I can implement this here or not, or say, oh no, this is utter nonsense. So okay, everybody got lucky and made money, but I'm not going to do it. But a different thing is, whatever everybody's doing, I'm going to replicate that, and I'm going to trust my copycat, and that will get everybody's rules, and well, I'm not sure about the level of confidence you can have on that.
Yeah, well, once again, it's a product that they're selling, and we can't predict the future, and we can't really predict how good they are and how it's, what's going to happen, because now that CTAs know about this, they'll have a move to make as well. However, to address your questions, so I can just imagine someone going over my track record and saying, and replicating it and saying, okay, all right, so here they are starting out in 1988. Then we replicate the 88 and 89, but we can see starting in 90, they become a bit more long-term. And then we see in 95, they're less leverage. And then we have no explanation for 96. It looks like Chesapeake did some discretionary trades. So that's jumbled, but it's right back in the next year, right back to following the system again. Once again, getting a bit more long term. In the early 2000s, we can see they're starting to add equities. Yes. Okay. So then let's fast forward to 2022, and they say, okay, now we haven't seen a much change in risk and leverage. We see a few more stocks being added long term, like crazy, like no one else. No vol management, no correlation management. Now we pretty sure, giving this low sample size of the past 3 or 4 years that we have, where they're being very consistent and the replication is coming back as sort of nailing exactly the parameters. Now let's take those parameters and let's back test them over the last 40 years. How well is this system? So I think you go from, we are telling our clients that we have a good product here because we're replicating the SocGen index and charging less fees, to we're coming up with another way to do research. Unfortunately, it's on the back of people who are spending money for the research and trying to remain proprietary. And then we have proven that those rules that we replicated are pretty good, given that we took them and did our own back test.
Yeah, but I think that's a much more robust process, because you're saying, okay, I'm getting in the game right now. I don't know anything about trend following, so I'm going to learn from the best. So I'll try to figure out what's the rules that the best in class use. Now that I've done my research, I learned what's the rules, what everybody's using. I know why they're using those rules. I understand the reasons. I see the limits. Now I'm going to use these that I've identified as being the best rules available. And starting from now, I'm on the frontier now. I'm shoulder to shoulder with the best in class. And now I'm going to do my research, and my new research, so as to say, and develop or enhance the systems that I've come up with. That's one thing, but that's not replication. I mean, that's not trying to replicate performance, ongoing performance of everyone's. I see this second suggestion you did as a much more robust process.
Yes, it'll be interesting to hear, because Andrew and I are good friends on Twitter, and he wonders sometimes, is Jerry in favor of this managed futures thing? I mean, I'm kind of in favor of him replicating managed futures, but I read another tweet today, and the guy did a very good job. I liked it, and I commented on it, so you can find it out there this morning. He basically says, managed futures is trend following plus a lot of necessary overlay. And if you don't have this overlay, then you're going to blow up. Okay, so Rich and I are going to blow up because we don't have a big overlay. Well, okay, so obviously I didn't agree with that. But Andrew and I are good friends, and I'm on both sides of the fence, because on one hand, I like that he's replicating, and I would not have the same opinion if he tried to replicate me, but I'm not a fan of managed futures with trend, which is trend following plus overlays. So but one of these days, I'm getting to it here. One of these days, Andrew and I will get on a podcast together, or over coffee or a beer together, or on Top Traders Unplugged or somewhere, and Spaces. Let's get Andrew on Spaces, and we will chat about all of this. He's formidable. He's a smart guy, and he's got lots of experience, and he's been successful. And I'll put to him this question, or maybe people who have interviewed him, they've asked him good questions, but not the same questions that I might ask, or Niels or Rich. So we'll ask him about this next step in replication, and he'll probably have a good answer, and have answers I haven't thought about, because he's not new to this. And just look back to what I was saying, and please refute this. And I'm not going to be offended, but if you're the majority of CTA managed futures is just the way Niels describes it, and that is you don't have to trade 200 markets because you can get a good representation. You don't have to trade every currency. You know, okay, the yen has gone a long way, but so have a lot of the other ones. You don't have to trade every interest rate. They're all 95% correlated every day. They all going down. You don't have to trade all the different commodities because the grains, every grain went up and on, right? That's true in managed futures, not true in trend following, because managed futures prevents a crazy market like canola and rapeseed from getting out of control in making 200 ATRs. It gets them back in gear to make about the average of the sector. And that's why it's easy for him to have 10 or 15 positions, because managed futures CTAs are sector. They make money. Mark has mentioned this on Top Traders Unplugged many times. And it has nothing to do, for me, it was about Tesla and Moderna last year or the year before. And so, but for this year, when I'm caught up in it as well, with the sectors moving, and you really can't go wrong yet, and there hasn't been a currency or a interest rate that has been a tremendously large outlier as compared to some of the others. I mean, you could argue with that. You know, the short-term rates have been much better, but it really is the fault and a result of the way managed futures trades with this risk management, correlation management, vol management overlay.
Yeah, sorry, Jerry, I cannot refute that. Trend following is all about what has not happened yet, what the next outlier will show up, and how can we best extract profit from that. Yeah, look, I'm being too harsh on that replication strategy, and perhaps I'm going I'm out of my league here. Of course, Andrew is successful. Of course, his product looks great. Of course, it's good for us trend followers to have such good marketing going on. But what the thing is, it smells like forecasting to me. It smells like I'm trying to forecast what's the next position CTAs are going to take. So that's why I'm so resistant on that.
I guess another element of it too is as the CTAs gain AUM and as they deal with the market environments that we're all dealing with and we're all seeing in the back test, just like Rich and me, they would tend to be longer term. And so which makes the replication easier. And I don't know if it's harder or easier to replicate one manager. Maybe it's easier to replicate a group, probably. So yeah, it may be a lot easier to do a group of managers. But to some degree, a skeptic could say, why are you even replicating? I can replicate what's going on now. I don't even have this replication algorithm on Excel set up. So, I mean, what's the big deal? Long dollar, short bonds, and pick out your currency sectors and, short LME, short precious, long crude. I can do that, and I haven't changed my positions in months. And why do you even need a fancy replication? It's very easy, and that's the point. It's very easy because they're not hunting outliers, and they're not continuing to add markets after market after market, and it's just a different way. This is the downside of adding risk control overlay to a strategy that initially was developed to let profits run. And they're not missing any big, huge outlier. An outlier gets smacked and slapped and put in the corner because you're too darn volatile.
Yeah, and that's a thing too. Perhaps replication is easier on the big funds that compose the SG Trend Index, because they're focused on these big markets, these larger markets. So the equity indices go about together. The interest rates futures do the same for the big markets. So here is a thing that makes replication easier. But as you just said, if you're doing classic trend following with frontier markets, with less liquid markets, then it's much harder to replicate, and it's much harder to follow to follow your replication strategy too. What are you going to do when the market opens gapped and you don't know what the trend follower next to you that you're replicating is going to do? Your system is saying, no, stay long here. The market's crashing. You've already lost, I don't know, 100 basis points with this trade. You thought you were going to lose 30, but you're already 100 down. And no, I'm going to follow my replication strategy. And then come next day, you discover that trend follower actually went out before you could figure. And you're left with that huge loss. I'm going to log off and come back in because I can't hear Moritz and Mentor. I even think that I've spoken on top of them. So I'm going to get back in a moment.
So one of the problems with this sort of an approach is, if they are trying to replicate a group, of course their results are going to be average, isn't it? So it's not very different in index investing, where certain people are happy to get that average return, and that's the whole idea. When you're investing with a certain manager, you know that you're seeking a little bit more than the average. So that's why I don't like the idea. I mean, I believe investors will be seeking more than an average. So a replication process that gives the average will produce suboptimal returns for the investors, in my opinion. Thank you.
But
I agree, Trading Mentor. And my thoughts are, I'm not threatened by this CTA replication because I know full well how much randomness there is in long-term performance data. And I also know how difficult it is to go from a back test to a forward test and achieve the same results. So I'm not threatened whatsoever by it because anyone, this is a problem that I think many people face is in their assumptions of the back test, their reliance on the back test. I did an exercise which looked at selecting from the TTU trend following index, which has 58 programs. I did an exercise where I said, right, let's look at the last 30 years of data and provided by the programs in that TTU index. And then I said, now generate a back test to develop the top 10 programs in that index that produce the optimal risk-adjusted return. That's really easy to do. You just iterate 10, a selection of 10 from that 58, and you continuously iterate until you come to an optimal blend. That's a backtest process. That's curve fitting. That's overfitting. But then what you say is, well, in reality, we don't have the benefit of hindsight. We don't have that 30 years of track record when we're trading on the right-hand side of the chart. We're going into the future. We're not going into the past. So therefore, how do you replicate that process? How do you achieve the same level of equity curve in a forward test environment on unseen data? And so there is a process we can apply to get close to that, but it falls short of what the optimal backtest solution comes to. Always, the forward test result is always undermined because there is hindsight bias, there is selection bias in the backtest. So these CTA replicators who are reverse engineering on the assumption that they can replicate trend following performance, I think are going to be severely disappointed over the long term. Yes, their short-term track record might sort of give them a sneaking suggestion that they're close, but you're going to get significant dispersion over the long term that I just don't feel threatened by it.
And I'm basically that if you're doing real trend following where you're focusing on the outliers, you shouldn't be threatened. They're not coming after you. They're only coming after sort of the style of trend following that tries to get take some positions off of the outliers if the volatility and correlation increases, and it makes their job easier. These are the top CTAs. This is a good investment. It was a good investment if you were to go to someone and say, "Hey, as a professional CTA, do you think it's good to put my money in a fund with the top 20 CTAs?" Oh, of course, of course. Now, you may be one of those CTAs, and so, but I would even say that I'm not one of them. Yeah, it's a great investment. So is the ETF. Everyone in Managed Futures has recommended a portfolio of more than one CTA. So this is not. It just gets back to the point of, if you invest in these CTAs, the data shows, okay, it's only 3 or 4 years old, that 2 or 3 years old, that they have been able to replicate it. And all of the research and all of the changes and that these smart top CTAs make flows right through to the ETF, the replicator, who doesn't even know necessarily what is going on behind the scenes. He just knows what positions reflected that recent performance. And before it would begin, I would have said, it can't happen. I don't think you can happen for all the reasons that were said. Now it is happening, so I don't know.
Over a short-term space, Jerry. Like, when I look at the programs, this is outside of trend following world, but if you look at the SPIVA reports, which report on the performance of a huge array of different programs that are all trying to achieve benchmark performance returns of the S&P 500. You find that 95% of those managers underperform that, and this is a problem. In hindsight, it seems easy to be able to even perform against the benchmark, but the reality in the practical implementation of actual live trading performance inevitably underperforms that benchmark. So those CTA replicators, that they might have a 3-year success story that makes us concerned, but our success story is over 20, 30 years. As we all know, that's what drives our long-term performance. Let's see if they can do it over that period of time.
Let's not forget, Jerry, that in the last 2 or 3 years, performance has to a large extent come from the big sectors like fixed income, currencies lately, energies. Those are the markets that they can trade. Those are the markets that they do use in the portfolio. But let's wait for the periods where performance are coming from smaller markets, maybe. It's going to be harder for them to do so.
Well, that was a point that I was going to make, and that is that, and I keep making that point, but Andrew mentions many times his go-to line is no one has ever said, "Hey, I'm up 5 or 10% this month because of pork bellies." I'm going to tell him that pork bellies no longer exist. But he's basically making that point, which is, it's okay for me to ignore the small markets. And it's the same if you would have said bean oil, big, huge move. Tin, probably the biggest move. Palladium had a big move. Canola, rapeseed, sunflower seeds. Go on down the list. But most CTAs, if you would cut back on all of those big outliers to where they would not be a big outlier. And it's back to sector again. And bean oil is going to be cut back if it gets too volatile and the grains get too correlated to where it'll look more like soybeans and corn, which were decent trends, just not nearly as large as bean oil, canola, rapeseed, and same with the LME. Copper, aluminum, nickel, lead had a good move, but tin was by far the best, but not if you correlation manage tin. So he's correct. Not about me, because I'll say to him, no. I made 30% in 1990 on heating oil alone because I traded heating oil, and I did not assume necessarily that I should cut it back based upon volatility or its correlation with crude and gas. So I think that there is not going to be this risk that you talk about of what happens when the small markets move, because for those large CTAs, nothing's going to happen. I wasn't able to hear much of that, Moritz. I didn't want to cut you off because I wasn't sure.
Sorry.
But we didn't get much of that at all. I wanted to go back to something that someone said, which I agree with, and that is, one time period that stands out that I'll never forget what happened is that COVID period when the markets all started to crash in early 2020. And I don't remember, the track record was posted, the equity curve was posted today. I'll have to go look at it. But I don't remember how the ETF did during that period. But you would think that there would have been some massive slippage because of just waiting a few hours to do the trade. Was trading on the close or trading on the open would have had tremendously different results. And these are replications that trade days or weeks after, and those positions, all those longs in currencies, commodities, interest rates, and stocks needed to be reversed as quickly as your system allowed you to. So I'm sure that was an issue and can be an issue in the future. However, fast forward, and over the long term, since inception, 2019, it's done better, the ETF. I can read you Moritz's tweet. Said, "My bet is not on Andrew. Fragile, risky business and trading with a short track record. Many hedge fund replicators popped out. All went out of business. Better idea is to create a trend following index that actually includes the rules." Absolutely. I agree totally. Anything anybody else wants to talk about today? Andrew sent me a question today on Twitter. Trend following club question: when you're expanding your selection of markets by adding equities, what qualities are you looking for in addition to wide diversification? And are there reasons to not use ETFs other than to search for outliers? What just look for stocks that are diversified in different types of businesses from A to Z. I think that I might have some sort of preference to smaller companies versus large companies with many different lines of business, but I don't know if that pans out on the data. I can show you many charts where there was huge monster moves by some of the largest companies out there, the largest in their sector, and they had the biggest moves. So I think it's hard to predict which markets to trade, except it is very valuable to have lots of diversification. And you can tell ultimately the type of diversification you have, in essence, when you look at the data, and you can see that, especially when it comes to stocks, that it's frequently, you're not 100% long or 100% short all the time, but you have a mix of longs and shorts and flats. Doesn't always happen, just like in the currencies, we're short almost all of them, bonds were short almost all of them. But in stocks, especially these days, there's a lot of longs and a lot of shorts from a trend following perspective. I don't like ETFs, of course, because they will mute the outlier a bit, and it's better to apply your trend following to the constituents of the ETF individually, rather than, we're not really in this asset allocation game apart from trend following it. If you want exposure to something from some sort of fundamental or discretionary point of view, I want exposure to semiconductors or retail, then that's not trend following. That's prediction of which sectors are going to do better, where in my portfolio of currencies, commodities, stocks, and bonds, I'm just trying to find the next black swan, which is unpredictable. I'm happy if all the stocks go up or all the currencies go down, but I know that in the long run, I'm going to make most of my money from the individual markets that have a big move and go much further, for instance, than the average move in their sector.
And I want to tell him a story that is a little funny for me. So, in 31st of December of 2019, as I remember, I met one guy in New Year's Eve. I met one guy. He is a manager in investment in famous investment bank in Russia. And we began to talk about trading. And he said that there is, in fact, there is no problem to a trend follower to have a good performance, because it's very easy to predict what markets will be performing well and trade only those markets. He said this. It's what a problem. Why are you seeking a problem here? So it's very easy. And I didn't want to listen all this stuff. It's not interesting for me. But it's funny for me now because it was the eve of 2020, 2020, as I remember. So in maybe 1 or 2 months, I think that guy saw how unpredictable markets can be, and we all see this in 2020 crisis. Oh, we see all this. We all saw this, and it's funny for me to remember that only maybe in 1 or 2 months before that crisis, a guy said that it's okay to predict the market and no problem with that, and you will be very wealthy. It's funny.
Hi guys. So last week, Niels was discussing about this mandate, the CTA mandate, where everyone else has at least one mandate of providing non-trivial risk-adjusted returns, but there was the second one, which to be able to provide no correlation to a 60-40 portfolio. Now, as the decades pass, I noticed that the second mandate is more of a, it's kind of, I'm not quite sure it's the right way to put it, but maybe it's a self-limiting belief. When I was listening various podcasts in the last 10 years, I heard that many CTAs in 2012, 13, 14, when they were going into these podcasts, when they were first become mainstream, they were all talking about this benefit of CTA investing, that they are uncorrelated to a usual 60-40 portfolio of stocks and bonds. But now, when we started to incorporate, of course, the stocks into it, I guess what we're trying to do is we are trying to provide this non-trivial risk-adjusted returns, which is in my opinion, it's a mandate that makes sense. But the second one, I mean, why do we need to aim for the second mandate? Maybe in the past this was the result of the processes that the trend followers are providing, but I don't see it as an essential quality that we need to shoot for. But, it might be the result of our processes, but I'm not quite sure whether it's a mandate we need to stick to going forward. And I would love to hear more experienced people where they are from today, and how they're approaching this second mandate of being non-correlated to a 60-40 portfolio. Thank you.
Yeah, that's the article I was referring to a couple of minutes ago. The article from AQR that Niels and Mark talked about on last week's podcast. I would say that, as I said, I wouldn't say it is a mandate for trend following, and I think it shouldn't be, but it is a feature that we are uncorrelated with 60-40 or with buy and hold or whatever. And as I just said, if people find these appealing, if this enters in their preferences, well, it's fine. I have no problem with showing people how uncorrelated we are with usual investments options. I have no problem with telling them that the Sharpe of their portfolio will be larger, will be better if they have a meaningful allocation to trend following, and that's okay. But because that enters people's preferences, the usual investor he likes Sharpe, he likes uncorrelated investments with his 60/40. But then again, I don't think this is a thing we should strive for. We shouldn't design our systems to have this so-called mandate, because when we start looking for uncorrelated performance, then we are trying to forecast. Then we're trying to keep our correlation low as for an end in itself, and that's the first step. I would say that's the first step in degrading the good qualities of your trend following system.
Yeah, look, I think the uncorrelated nature of a trend following program is just a natural consequence of our diversification across asset classes. Extensive diversification, it naturally produces an uncorrelated relationship to a single asset class, such as equities or such as bonds. It's going to necessarily be uncorrelated if trend followers are doing their job correctly in diversifying. But this, I don't think there's any mandate as such. It's just helpful for allocation purposes to know that you can utilize an uncorrelated return stream as an allocation property. But I think it's just a natural consequence of our method that produces that result.
But if we continue to include more and more single name equities into the portfolio, there's a good chance.
Long and short.
Yeah, long and short. So there is a good chance that maybe that's uncorrelation to a 60/40 might be less there going forward. I mean, I personally do not believe in reduced return stream just to keep that uncorrelation property there. So if I can get a better risk-adjusted return, I would rather add more stocks into it, even though this is going to cause me to be a little negatively or positively correlated to a 60/40 portfolio. So the thinking is, I'm trying to say, I rather do not have a boundary, a ceiling kept onto the mandate. So I rather be as flexible as possible in the portfolio construction, rather than go with this uncorrelation mandate, which was a selling point historically, probably, if I'm making sense. Thank you.
That does make sense. But I think a lot of trend following programs, particularly the bigger ones, are in the business of trend following. So effectively, they're probably getting more allocations from retirement funds and all of those things that have a small allocation to trend following, and therefore, but by and large, that level of allocation is probably much larger than what people are 100% investing in trend following. So in other words, their business is in the business of allocation. Their business is in the business of providing a particular return profile for ensemble portfolio aggregation purposes. And I think a lot of trend followers, the big ones that are attracting AUM, are particularly focused on that. They're less focused on the properties of trend following delivering long-term net wealth, and they're more focused on the properties of trend following delivering an allocation benefit for a retirement fund or something like that.
And I think that we are talking about, of course, it's good to trade different maybe kind of stocks that looks uncorrelated. So, of course, with one company, for example, is a tech company, the company produces food, and of course it looks uncorrelated, and in our daily routine it's uncorrelated. But when we see a crisis environment, stocks often, if not always, begin to go to one. all the companies. And here we must think about correlation, about diversification, and we always must think about diversification across different asset classes. And of course, as I always say, and Nils always says this, and all the guys, that commodities, and I think it's maybe the most important sector, if we can say so, that one sector is more important than other. But I think that at least, as Neil said, that it's better to have diversification. It's a better diversification, more diversification benefits between, if you say trade SP 500 and corn or one of the metals, for example. Then you trade between you diversificate across two stocks from even very different fields. And I'm sure it's so because stocks are financials. It's financial instruments, and historically we see that often it goes in one direction.
All right, maybe we're tired of replication, so that's good. Anything else anybody wants to bring up today? I know Rich put out a really good tweet this morning Eastern time, New York time.
I've just got to remember it now.
Yeah, well, it's the same old stuff we always talk about, but you just have a way of making it sound really, really interesting, letting profits run, not cutting losses, not cutting profits short. Well,
yeah,
anyway.
I think it was actually it was on the rebalancing idea. Like, we often hear about risk parity having this this rebalancing premium, and yet that's legitimate in the convergent world, but certainly in the divergent world, I don't think our intent is to get any benefit from this rebalancing premium, because we're targeting these outliers, and if you try and rebalance away from those outliers, you're going to be sorely disappointed in your overall returns in the long term.
Yeah, I like that. And then I sort of look at it as, trend following is this non-random rebalancing. It's funny that in the traditional stock and bond world, rebalancing comes up a lot, and it is probably random, and people swear by it, and they have their ways of doing it. And then every now and then I'll see a paper and I'll tweet it, and it says essentially that you're going to get in trouble historically rebalancing out of the trend. So, when stocks are just going great and the trend is up, and now you're becoming 60-40 is out of whack, selling those stocks and going into bonds, there's a cost to that. So they're feeling this reverb from counter trend trading essentially. And then that fades away, and then people go right back to rebalancing. It's wonderful. You have to rebalance. I love rebalancing, and not sure how it works on the numbers, but it does. Anytime you can have an excuse to take profits, that people really love that idea.
It has a lot to do with how people understand and approach markets. This rebalancing thing is tied with that classic or asset pricing models we get from finance or economics classes, that there is an inherent property or an inherent risk premium associated with every asset, and that's what brings you money. If you have exposure to different assets, you're going to fetch these premiums on your portfolio. And as you and the other things that explain an asset performance is random. It can go one side or the other, and that's what you want to avoid. So if you rebalance constantly, you're enhancing the chance of getting this different risk premia that different assets can provide you. And if you don't, you run the risk of being increasingly exposed to a factor risk you don't want to be exposed. And that's the fuss about rebalancing on my view.
Yeah, no, that's right, Bruno. But the bottom line is that there is definitely a rebalancing premium. There's no question about that. But it's not applicable for trend following, 100% trend following. And the rebalancing premium is based on the mechanical principle of portfolio construction on basically equal weighting. And it's just a natural consequence of reduced volatility. It's actually a smoothing effect. So, you know, we of course have these issues with this volatility smoothing, but that is what rebalancing premium is all about. And you do get a slight premium from that when you are trading across strategy classes, such as, you know, risk parity portfolios, etc. But when you're targeting outliers, our whole philosophy is cornered on the principle of these anomalous, non-linear benefits we get from outliers. And if you do seek to rebalance during the course of your, you know, we actually do rebalance. Trend followers rebalance every time they enter a trade, because if you imagine it, when we are entering our trades, we're making an equal risk bet at all points across our portfolio at that particular point of entry. So we are risk balancing at the point of entry. But when we are actually participating in that trade, we do not try and tamper with or adjust the profits. We let our profits run. But rebalancing is based on a principle that they will adjust those profits. They will rebalance during the course of their, you know, across a risk parity portfolio. They will rebalance, sacrificing some of the upside potential of their better performers and to invest in their lower performance, which is getting a benefit from the random nature of the relationship between those asset classes. This is not applicable in our trend following world. And if we did apply it, we would sorely deplete our overall performance returns.
You can even argue that we are on the other side of the counter with these rebalancers.
Yes, we're divergent. This is convergent. What we're talking about is convergence.
No, what I'm saying is, suppose there is a reason why people don't like being overexposed to volatile assets. So if they don't like, they're willing to pay money to not be in these assets. And we are on the other side of the counter say, okay, I'll get your money and your risky assets, no problem. That's not a risk I care about. That from an asset pricing point of view, I'm saying is that we may be our strategies may be maybe taking the good side of that rebalancing premium. We're fetching this premium with our uncaring approach. That's what I'm saying.
Not something very maybe important, but I think that this rebalancing, I agree with Richard, and it's very interesting to hear from Richard, because I thought maybe something similar, that we don't. My thought that we don't need maybe such a rebalance like guys from another fields. And I liked when Richard said that we rebalance every time when we do our trade. And it's a very interesting point. I only wanted to say that I'm impressed by this point, and I like this.
Hi guys. So you know, actually, the last week's discussion with Moritz pointed out a property that I have overlooked. You know, the fact that the short-term trades have a limited upside. Upside, because let's say that you're in year 2014 and we are running a long-term trend strategy, and we have shorted the crude oil from $100, and you know, if you remember 2014, that trade has gone down from $100 to around $30 over the course of a year. And what has happened is, of course, you're opening that trade from an ATR position at the beginning of the trend. And because you're a long-term trend trader, what is happening is you're not rebalancing your position. And I'm never for rebalancing to cut your winning position short. So I'm never in that camp. But in that conversation, I noticed that you will be leaving a lot of money on the table if the volatility is going from $10 per barrel to $10 per barrel to $1 a barrel. Okay, so actually, if you would be a medium-term trend follower, you would have multiple entries perhaps during the year. But if you're a long-term trend trader, what has happened is you just ride that trend once, and your position size is really limited to be able to make the most of that outlier. So, and I thought maybe just upsizing the position when the volatility goes down half of it or significantly down might give more upside on the short-term trends only. Otherwise, there is a big, I believe, injustice to the return stream that might come from short trends, especially if those short trends are longer-term trends that might last a year or two. That's what I thought about it. I'm not quite sure how others would feel about adding into those positions for those limited circumstances when it is only a short trade, when it is open for for many months, and when the volatility goes down. Actually, thank you.
I've heard reference to the splitting a portfolio between S&P and trend following, creating a better Sharpe ratio. Does that how does that work as far as rebalancing goes, or is it just a buy and hold type of strategy for each?
That's a good question. I think it's done, differently, probably. I think there's a couple of hedge mutual funds out there, Milburn, Standpoint, who have a permanent allocation to stock ETFs or indexes long. I know Abbey has something as well. My recollection is that Abbey takes they have one fund, I think, that takes more of a hands-off approach. So there's a certain percentage allocated to long S&P all the time. And then I think the other two probably exercise a bit more imagination as far as not just the S&P, but different types of ETFs or stock index futures long, to probably not a fixed all the time certain percentage. So I think it helps, certainly over the past 20 years, if not longer, and certainly over the past 10. The problem has been that there hasn't been any sustained downtrend in the S&P. It's just had a V bottom a few times since 2008. So trend following doesn't work well on stock indices, and in that particular scenario, and also the index S&P itself has done very well. So pairing those two together. Now I know that Standpoint trades in indices in the futures part of the fund, the managed futures part, and so they would be short some stock indices. So maybe to the degree that it would offset some of the losses in the permanent long part of the portfolio. So unless we got a sustained downtrend, their performance would probably look pretty good. Although if we got a sustained downtrend in stock indexes, like in 2008, they may not perform as well as a typical managed futures program that is short indices without having a permanent longs. So it's a pretty good marketing thing. And then you just tell all your clients how much you can believe in both the long-term benefits of the equity premium and how great managed futures is as well. And they want to hear that. And you kind of take the ball out of their hands in saying, hey, just give me the money and I'll choose between how much managed futures and how much stocks. So it really, a lot of clients don't want to have to make that choice. And but my idea is to add the stocks, add a lot of stocks. That 50% sounds good, but then trend follow those stocks and make them individual stocks, long and short, because I think that's what these portfolios need is more trend following of their stocks versus just buy and hold the stocks, and I'll allocate 5 or 10% to a group of CTAs. So I'm in another camp where I'm not going to give up on the benefits of trend following stocks as well as well as the currencies, commodities, and interest rates. So that's my strategy, a bit different. And the risk is that trend following doesn't perform well, even if you trade 100 stocks. It's probably do better than just trend following the S&P. But if you look back at that COVID period, I've scrolled through like 1,000 charts, stock charts, and unfortunately, all those charts look very similar to each other and to the S&P itself.
On a bit of a separate topic, is there how do you guys think about position sizing when entering new positions, when you're having a banner year versus your portfolio is in a drawdown? Are you looking to make it a fixed rate position size, or do you adjust based on overall portfolio value or stop out portfolio value or something like that?
Well, I'll try to keep it short in the interest of time, but so I think it's, if you're going to trade like I do with not cutting back positions when volatility and correlation increases, and the positions being the problematic positions are going to be those big winners, then you need to take precaution on your trade level. The question you're asking, like, how are you going to deal with this when you're making a lot of money and a lot of your the value of your portfolio is wrapped up in these open trade profits? So I implement a very conservative trade level that I use to base my quantity and my maximum dollar loss on. So it's usually something like the closed trade equity, which is the total equity, but does not include open trade profit. So I don't want to get into a situation where I am increasing my trading size on future trades based upon fleeting open trade profit. I mean, it could be fleeting, it could be just the beginning. You just don't really know. So on one hand, I'm going to let the profits run, and these small little positions that I put on months ago have now turned into these very large positions, especially in relationship to all the other trades, because I haven't reduced them based upon their current volatility. They really are dominating the performance or making life kind of good some days, bad other days. So what am I going to do to offset that is to have an artificially low, maybe, is it artificial? I don't know, but I'm going to have a lower trade level that's used to calculate my quantities, new trade quantities. I'm going to keep it a lot lower than the total assets in the fund. So I've talked about this on Spaces and in podcasts a million times. So it's difficult to put it, into a short explanation. But I think that, today, like, there was this one tweet that said, if you trade like Jerry, you're going to blow up. I mean, essentially, he didn't say that, but kind of, if you don't exercise vol management, correlation management, you will blow up. I think that we don't want to blow up. So what we do is that we have this draconian way of calculating trade level to keep us from blowing up. And so we have our cake and eat it too. We're going to let profits run and not scale them back. Part of the problem is if you're using current AUM, you better do something. You've made a mistake. You should not use current AUM. So here I go. Then what are you going to do? I'm going to vol manage and correlation manage. Not optimal, but I feel your pain. But what I'm going to do is change my trade level calc so I don't have to cut profit short. Oh, do you have anything to say about that, Rich?
No, Jerry. We use the realized balance method of calculating our trade positions. So, when we get into a drawdown, if it's a drawdown off our unrealized equity, we're not really doing anything. But if certainly if our realized balance is being compromised, we will be effectively reducing our position size. That's all I'd need to say.
How was that, Brett?
Fantastic, guys. Thanks so much.
All right. I think it's time to let Rich go to sleep. It's late in Aussie land. And so I will sign off and thank everybody for being here and contributing. And send me some questions and topics for next week if anything comes to mind. And I hope everybody has a good weekend. So take care, everybody.
Bye, everyone. Bye.